Understanding the DC Unincorporated Business Franchise Tax is crucial for businesses operating in Washington, D.C. This tax can significantly impact your bottom line, so let's dive into the key aspects you need to know. The DC franchise tax applies to businesses with gross receipts of $12,000 or more, including partnerships, S corporations, and limited liability companies. It's a mandatory tax for those operating within the District of Columbia, but there are important nuances to consider. For unincorporated businesses, the franchise tax targets those earning over $12,000 in gross receipts from DC sources. This includes sole proprietorships, partnerships, and joint ventures, generating rental or other income within the district. However, there's an important exemption to note. If you're primarily engaged in personal services and capital is not a major income factor, you might be exempt. Specifically, if 80% of your income comes from personal services to members of your business entity, you may avoid this tax. While we're focusing on unincorporated businesses, it's worth mentioning that corporations also face a similar tax. They must file Form D-20 and pay a minimum tax based on their gross DC receipts. The thresholds are $250 for receipts up to $1 million and $1,000 for receipts over $1 million. DC has implemented some specific rules that affect how businesses calculate their franchise tax. They use market-based sourcing, which means income from services is considered DC sourced if the customer is in the district. Additionally, DC employs a single sales factor apportionment, where businesses apportion their income based solely on sales within the district. These rules can significantly impact your tax calculations, especially if you serve clients both inside and outside of DC. When it comes to filing, unincorporated businesses use Form D-30. You must report all income sourced from within DC, including rental income. If you have multiple partners or members, each member's share of the income must be reported. Accuracy and timeliness in filing are crucial to avoid penalties. If you need more time to file, you can request an extension. For unincorporated businesses, you can get a 6-month extension, or 7 months if you're a combined reporting filer, by submitting Form FR-130. Remember, you still need to pay any estimated taxes due when you file for the extension. Be aware that late filing or payment can result in significant penalties. Generally, you'll face a 5% penalty per month on the tax due, up to a maximum of 25%. Interest also accrues on unpaid taxes, so it's best to file and pay on time, or file for an extension if you anticipate delays. Lastly, there are some special considerations to keep in mind. For consultants and self-employed individuals, if 80% of your gross income comes from personal services and capital is not a material factor in your income production, you may be exempt from the franchise tax. This exemption can be particularly beneficial for many self-employed individuals in DC. Understanding the DC Unincorporated Business Franchise Tax is essential for managing your business finances effectively in the District of Columbia. Always consult with a tax professional or attorney to ensure you're complying with all requirements and taking advantage of any exemptions you might qualify for.